Is cash the best hedge right now, given heightened market volatility? Julian, this is something that came up quite a bit at Davos. We talked about cash. Is that where people are really fleeing to?
There's no question that is happening. And we would say, in some ways, that's a rational response. And rather than spending money on protection, whether it's in the high yield market or in the equity market, which is expensive right now because volatility, although not super high, it's quite high. Cash is good because it also gives you the flexibility to, once you work through your fears and your emotional angst, that you can put it to work.
I got to tell you, last week, as David mentioned, we sat down with the co-founder of Canyon, one of the most successful high-yield and credit hedge funds out there, and specifically around sitting in cash, why they're doing it. Take a look.
We're running about 20% cash in one of our funds, and we do restructurings such as Caesars, Clear Channel. Those are ongoing, longer duration situations. But more generally, the issue is the following. When the markets are like this, you can't predict with certainty. So if you have liquidity and you're not leveraged, which we never do, then you can afford to wait. Pick off situations selectively, and then when things get perhaps even more interesting, you can be more aggressive.
So to put in perspective, so he said 20%, that's a lot for them. And it's not that they're negative on the market, they just think the market is going down further, so they're going to be buying several months from now. And Canyon's crushed it.
How nice for them that they have that luxury. What I'm concerned about is the pension plans and some of these investors that really need to generate 7% income, 8% income. I've heard anecdotally that they've been boosting their cash allocation as well to some of the highest in a long time. And, they cannot necessarily afford to earn nothing. So, yes, Jeff Gundlach says also this is a time for capital preservation. At the same time, some people do have to go somewhere because by earning nothing, they are actually losing.
But you're better served earning nothing than losing money.
It's true.
That's what got so many investors in trouble in 2008 and honestly at the end of 2015. If you don't have the bandwidth, the investing principles or the gumption to be in a product like high yield, you shouldn't be in it just because you're not getting enough in the Treasury market.
But it also speaks to why volatility can work both ways in an environment like this. If you have a lot of people on the sidelines in cash and you see the psychology begin to heal itself, as we believe it started to slowly with last Wednesday's reversal, you really could get a rush into the markets as the data begins to get better, as the Fed begins to reinforce the knowledge that they aren't going to make a policy.
Well, we'll see if you're right, and goodness knows I hope you are right, but it strikes me that this is not the first time we've heard about keeping your powder dry. If you'd been here in December or November or October, there were people here saying, you know what, now's the time to be in cash because we think there are going to be opportunities for buying at this. This is not a new phenomenon. It's been a while
now. But the positive is also, this isn't a time to sell, it's a time to maintain your cash. Those are two very different pictures.
Yes, very true.
But if somebody, let's say, does not have a big cash stash, should they go out and sell what they have to sort of generate some in cash? Probably not. Right?
Actually, David sat down with Greg Jensen of Bridgewater and addressed specifically, does sitting in cash, does all that cash on the sidelines cause more problems? Because remember, you've got an investment banking world now where banks are no longer cushioning negative markets by buying up excess inventory. Take a look.
And the reason a diversified mix of assets goes down is when cash is the best performing asset. And that's what's happening with all weather. But that's also why the Fed needs to prevent that. If cash outperforms, the real economy outperforms. You've got a problem. You've got a problem.
So that's Bridgewater who's saying there's a problem when cash is the best place to be.
That set of circumstances is normally very temporary. Clearly, you had it for an extended period in 2008. We certainly don't see the same set of circumstances. But again, I'd reinforce the idea that at some point, as psychology begins to heal itself, cash is actually fuel to support asset prices.
Honestly, though, after so many years of stimulus, to have everything kind of quietly deflating and cash performing well, it's a vote toward a disinflationary environment, which is not particularly good for consumer confidence.
Well, I think that's another one of the very important issues. People are talking about China spreading deflation. we've already come down from $140 to the barrel to $26. It's really difficult to argue, although we did hear talk of near zero oil last week, which is part of the healing process in general. It's difficult to argue that you've got, you've only got $26 more to go. You've already come down 75%.